This is Seth David for schoolofbookkeeping.com, bringing to you another special screencast. This time we're talking about, do you need some tax deductions before the end of the year? Tax projections, year-end planning. This is a big issue, especially towards the end of the year. Funny how that works. It was brought to my attention by one of our students, Mariette Martinez, who's an enrolled agent, by the way. All she does is taxes. She specializes in taxes, and she has a need, like many of us do, at the end of the year to look at her client's financial information and project what their tax liability may look like. Now, the classic case that we look at is an S corporation, where it's required to pay officers' salaries, and in many cases what happens is the officers are taking shareholder distributions throughout the year, and then at the end of the year what we want to do is look at their net income, look at what their distributions year to date are, and we want to run a big lump sum payroll. And what we do is we run that payroll just to get the taxes paid in, and then whatever that net check winds up being, we zero it out, and that difference is as if they're putting that money back into the corporation, thus reducing effectively the distributions they took out during the year. So how do we look at this? We want to look at different scenarios. Now, the thing to keep in mind, one of the goals and objectives here is to make sure that our clients aren't paying any penalties. Now, how do we keep them penalty free? We have to make sure that they ultimately pay in either 90% of whatever last year's tax liability was or 100% of this year's. Now, of course, this year's is a little ambiguous because the year isn't finished yet at this point when we're doing this year-end planning. So to be on the safe side, and it's the lesser of the two, by the way, it's the lesser of 90% of last year's or 100% of this year's. So if we think this year is going to be a lot less, we can certainly estimate less. Bottom line is we got to look at the income and expenses year to date on the SCorp, see what that looks like, see based on that what we think that tax liability is going to be, and play around with some numbers. Now, to be on the safe side, Mariette had suggested that we use, instead of 90% or 100%, a threshold of 110% of last year's tax liability, just to be sure. So we've created this template. In fact, in our Hangout, our weekly Friday Hangout, which you can check out if you go to schoolofbookkeeping.com, and in the students area, you'll see weekly Hangout. It's free to everyone, the public. You don't have to be a student. But because she had raised this, we together in a Hangout built this template and started laying out what it looks like on the SCorp side and what things look like on the personal side. And then I took what we had created, and in a second Hangout and a little bit of time spent on my own, I created this nice tax projection template. And it's available free to students of schoolofbookkeeping.com. Just go into the Excel templates area and you'll find this. Of course, I'll provide the link once it's available wherever you happen to be watching this. The issue here is that we want to lay out some basic assumptions. So again, we said the penalty-free threshold we're going to use is 110%. We're looking at federal payroll withholding percentages. These are assumptions of 20% for federal and 10% for state. So the total withholdings we're going to assume that will be taken out of any projected salaries is going to be 30%. Social Security and Medicare we know is 7.65%. And then we look at, because also what we're looking at here is what things could we do to reduce the taxpayer's tax liability, legitimately, of course. And one of those things is having a SEP IRA, which allows you to contribute at this time, the end of 2014, up to $52,000 maximum, or 25% of payroll, whichever's less. In other words, you can't contribute more than 25% of what you've paid yourself. If that amount equals or exceeds $52,000, you've hit your cap. But that $52,000 contribution into the SEP IRA comes off pre-tax. So it's a nice savings if you need some extra deductions. And based on that, what I do here is I just do the quick division to show you that in order to max this out, you have to have paid yourself at least $208,000 in salaries for the year. So we have these are the assumptions. Then we go into data entry, and you're going to key what this information is going to come pretty much off your profit and loss and balance sheet from your SCorp or your company for that matter. So let's say the SCorp net income is $150,000. We'll just key that in, and let's assume you've paid no salaries so far. And let's say the distributions that were taken out year to date, and be careful when you're running the balance sheet because it is cumulative, and if the prior year's distributions weren't zeroed out, you might be looking at a bigger number than what you want to key here. Here you want to key just what was taken out in the current year. So let's say it was $100,000, which makes sense. If the net income is $150,000, there would certainly in theory be $100,000 available from that net income to have been withdrawn. Right? Then we want to put in last year's tax liability because, again, that's going to play into this 110% assumption, so we can take a look at what the potential or the minimum payments need to be to make sure we're penalty free. So we'll put in last year's tax liability, and let's say last year's tax liability was $30,000. I'm just making numbers up pretty much. Then we go to the next tab, which is the SCorp, or the company. Again, I'm using the SCorp as the example because that's sort of the classic case here. So right now we've got SCorp net income of $150,000, no year-to-date salaries. Here we're going to plug in any additional salaries, and for that matter, in this case, any salaries at all that we're going to want to pay, and everything pretty much calculates from there. So I'm going to jump to the bottom for a minute, and let's look at the quick analysis. We have projected net income of $137,635. We're going to talk about this in a minute because we're assuming we're going to purchase some major assets. And also, we're going to take an annual subscription to schoolofbookkeeping.com to get an additional deduction because most taxpayers are cash basis. So even though you're paying for a whole year and you're paying in advance, this is fully deductible at the time it's paid. So if you hurry up and go get a schoolofbookkeeping.com subscription, an annual subscription, you can get an extra deduction if you need one for this year. So we're assuming these additional deductions are going to come in and get subtracted from the $150,000 to arrive at a lower projected net income. Then we look at the distributions year to date, and there's no offset from the additional check because we haven't put in any payroll yet. And then we're going to come over here and we're going to look at some additional what the cash requirements are in order to pay in the payroll that we're going to run. Because remember, it's not the full salary amount, it's just the tax portion because we're going to zero out that net check, like I said. Over here, we're going to look at any SEP buyer contribution. Right now, it's 0 because we haven't paid any salary, so 25% of 0 is 0. Remember, it has to be 25% of any salaries you've paid. So finally, down here, we get to the net income of $137,635. We have the distributions carrying over from what we entered previously of the $100,000. And so looking at this, we would go over to the personal now, and we'd see what our potential tax liability looks like. Again, we have no payroll income. We have the SCorp. We're going to assume a tax liability based on 30% of the net income. It's very rough, but that's all this is. It's a projection. It's meant to be rough. So we're estimating taxes that would be due on that of $41,290. Right, last year's tax liability was $30,000, so the minimum needed to pay in to avoid penalties based on our 110% assumption is $33,000. So when we run that payroll, we want to make sure the taxes that are getting paid in are at least $33,000. So let's go back now and let's put in a salary number. Let's say we wanted to run $100,000 in salary, and let's see what that looks like. So I come in here, and as the screen lights up, because all of this is pretty much calculated except what you see in the green and yellow. Right, so it comes in and says, okay, our federal holdings are 20, so we're going to get $30,000 in additional salary, the withholdings from the additional salaries to be paid, which is fine. That's what we're assuming is going to be withheld from the pay. So the net check, additional salaries to be paid, is $62,350. That's what we're going to zero out to offset distributions for the year. So there's just carrying down the officer salaries. If we had already paid some salaries, that would be included here. And then it's adding, of course, the additional salaries we just punched in, which at this point are the only salaries of $100,000. Now it's letting us know, hey, you can contribute up to $25,000 for the SEP buyer. So we're going to assume we're going to want to contribute that entire amount. Now we have, again, $12,000 and $365 in the additional deductions. Now look at our projected net income, much lower, $49.85. We're going to take that $100,000 in distributions we had done year to date. We're going to zero out that net pay, so that's going to knock our distributions down to the $37,650. And then we're looking at cash requirements, $30,000 in the withholdings, and then the company share of the taxes comes to $37,650. That has to be paid in before year end. The SEP IRA can be paid later. What you can do is if you don't have the cash, you can file an extension, and you have until the time you file the actual tax return to pay in the SEP IRA contribution. Then we just do a quick ratio analysis here because we want to just make sure that salaries to distributions is a ratio that we feel comfortable with. Chris McLam, who is another enrolled agent who helped me with this in the Hangouts, had made the point that she likes to look at this kind of ratio to see and make sure that she feels confident that when the IRS looks at this, that they're going to be satisfied with the amount of salaries paid in comparison to the amount of distributions taken. And we talked about it being at least 50% salaries, more than 50% salaries out of the total. So this is that quick analysis for those who are interested in taking a look. Now let's go over to the personal. And of course things change. Now we have payroll income, but we have a lot less income net from the corporation. So we have this. We have a 30% tax liability assumption, which now comes to $31,495. The withholdings from the payroll are there to reduce that because that's already been paid in. for us. So we have an additional balance that we're expecting is going to be due of $1495.50. And we have the cash requirement again is now we're looking at the SCorp cash requirement plus the potential additional personal liability of the $1495.50. So total, we're looking at having to come up with $64,145.50 plus the set buyer contribution. Don't forget about that. Or actually, did this include that? Yes, it did include that. Never mind. I don't even know my own template because I just created it. So now we're looking at this and saying our estimated tax liability, total taxes due, is $31,495. It's a little higher than last year. So as long as we pay this much, we're covered because remember, it's the lesser of 100% of this year or 90% of last year. We did the 110% to be conservative. So looking at this conservatively, you might want to bump up the salaries a little more. Remember, your net income on the SCorp now is $49.85, so you can't bump up the salaries too much more or you'll put yourself in a loss position, and you don't want to do that. But what you can, if you're concerned about getting the extra $3,000 in taxes paid in, you could bump up the salaries a little bit. More than likely, I would look at this scenario and say it's probably fine. But this, in a sense, is the whole purpose of this analysis. And the idea here is you can go back and you can play with these assumptions and say, well, let's say we're going with just 90%. Go back to the analysis. Now we're good. Now we're saying we should have paid in at least $27,000 to cover the 90% of last year or 100% of this year, which is going to be the $31,495.50. So, and even having paid in only this $30,000, we're pretty well covered, to then pay in the rest with the tax return when we do the extension, let's say. And that, my friends, is how this tax projections template works. There may be some additional revisions. I'm still, as of the time I'm recording this, awaiting some feedback from Mariette and Chris to see if they have any suggestions for other things I can add. If you have any suggestions for things you'd like to see me add to this template, please let me know. If you aren't already, go become an enrolled student. Do it before the end of the year, and you'll get your tax deduction for an extra expense in the form of an annual subscription to schoolofbookkeeping.com. And the first thing you can get of value is the opportunity to download this template, which is probably alone worth more than the annual subscription cost that you're going to pay for schoolofbookkeeping.com. That's my shameless plug. That's the end of this video. I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web.